This question here, we're going to take, I didn't have time to put together slides for Dave's question about comparing the standard radioactive setup married put or doing an at the money put at the same strike price, of course, and then trying to force an income method right away. We're going to take a look at that with some help from the historical tools and more. So with all that being said, let's navigate over to the Power Options suite of tools. All right, so what we're looking at here is just a basic Power Options account. We've got the watch list here, market activity today. See, there wasn't too much movement on the broad-based indexes and ETFs, but we are seeing this VIX was bouncing around today. It was below 20 at one point, but then it moved back up above 20 later on during the day, right to the end of the day as well. All right, so to start, in the first few moments I had on Dave's question comparing the two, what I did is I used one of my positions, BERY, currently at 70.39. Had a big move towards earnings, or from earnings, I should say, in early May. Now, we're going to take a look maybe at two examples here. We might use Ally as an example as well. But what I did is I went into the back test. There's historical tools, which I can use a historical search based on criteria. We're going to use historical search by symbol. I'm going to look up married puts on or around April 27th, I believe is what I look for. And I want to see all results. And we're going to use the standard January expiration. All right, so that's the typical setup that would use about 220, 240 days out in time, 269. There we go in that case. And let's see here. So it doesn't give me the ones that I would use in this case. That's interesting. Maybe let's go to April 28th, see if that helps. Long story short, I did have the ones I wanted. I want January, and I want all results. There we go. That's a little bit better. So here's BERY at 62. And the January 65 put is what we would likely have used in this case. It's only a risk of 6.6%, midpoint of 740, and that's for 268 days out in time. But I don't see some of the other strikes here. The 60 strike, we'd probably consider that more at the money, or if there was a 62.5. So we know this risk here at 6.6%. Let's go to the option chain for April 28th for BERY Plastics. And let's go to that January series. Perfect. So with the stock at $62 at the close, Dave, and we do have a 62.5 strike, and the mid price was $6.50. So we're going to use that, the 62.50 strike at $6.50. We're going to hold on to the chain for a moment here. We're going to come back to it in just a moment. And we're going to go back to this history, but we're going to go into the portfolio tools. And I did enter that price of the 65, the one I likely would have chosen, Dave, slightly in the money, price of 740 for that max risk of 6.6%. Of course, we can see the stock's up 13.5%. No income methods, no adjustments. The profit here is at 7% by itself, just on the married put. This will link to Raymond's question slightly later, right after this topic, Raymond. Now, let's add in another position. Same date, the 27th or the 28th. I think I put in the 27th errantly on the last position, but that's okay. So we're going to enter same married put on the 28th. Stock closed at $62 per share. We're going to use the at the money January 62.5 put for a price of $6.50. I don't need to really do the dates here. We just want to make everything look accurate. Okay, now let's go ahead and submit that. And they're both about the same. Okay, the 62.50 is only $2 profit more in the case here of this position. Okay, the 62.50 right at the money, Dave, slightly above. Let's take a look at something here. Oh, I'm sorry, I want to go to the profit and loss chart. The at the money 62.50 strike had a risk of 8.8% on the position. The slightly in the money 65 put 1 or 2 strikes in that I would normally choose had a risk of 6.6%, but as we saw, was roughly 90 cents more. It was priced at $7.40. For only the price of 90 cents in this case, the additional cost, I should say, of 90 cents, what did we get? We got an extra $2.50 of guaranteed profit on the position. And as we've all talked about before, the at-the-money bell curve. This is what we use as one of the 3 core principles for radioactive trading. And what it shows us is simply that at any given time, on any given day, any given expiration, the at-the-money option always has the highest time premium. Whereas those options that are above the strike price, in the money for the puts, out of the money for the calls, will have a lower time value. And of course, those that are reversed, those that are below the price, out of the money for the puts, in the money for the calls, will have more intrinsic value and lower time premium. So this is buying right at the peak of the at-the-money bell curve. This would have been the highest risk at the time for any of the, well, highest time value, I should say, for any of the January options. Those down here with a lower time value would have had the highest risk because the stock would have to fall before the protection kicks in, and you're still paying a relative time value in addition to having that extra space where the stock could fall. Okay, so basically, that's one of the main caveats why we're using that position. Let's go back to the chain for a moment. Now that we've seen the 2 comparisons, a 6.6% risk versus 8.8%, this is 50 cents of intrinsic value to the 62.5 strike. The remaining $6, of course, is the time value, the true risk on the position. Now, I want to illustrate my point. Let's go to the puts only chain for January. Yes, and there I have it. Okay, so you can see here that the percent time value midpoint column for the puts on April 28th, the highest time value risk is at the money, 62.5 strike. The 65 was down to about 7%. And, as you go deeper, you get the lower. This would be the maximum risk. These are lower time premiums as well, but now the stock has to fall to that price. So it'd be a drop of 10 points plus the 3.6. That would be a 13.6% true risk on the position. That's why we typically don't use the out of the money options. And when you're going at the money, you have the highest time value. And then, of course, it fades down here, and it fades as you go deeper in the money. And that's always the highest time values right at the money. Dave wants to offset this. He realizes he's taking the higher risk by paying into the higher time value, because one of the caveats of the basic income methods of selling premium is you don't want to do it. You don't want to sell an option unless the stock is trading at or above the put strike price. You don't want to sell a call below your protective put strike price because that actually creates a bearish position. Let's switch now. And we're going to go back to the call chain. Same date, April 28th. And you said 4 to 6 weeks out, but I'm going to use May. Today's expiration, Dave. And you had mentioned that, okay, we're looking at the at-the-money 62.50 put. And if we did an income method number 1, let's say we get midpoint, we'd sell the 62.5 call for $1.88. Or maybe I'll give you the 65 call at 95. Okay, so how would that look? All right, well, here's our position. At the money put, 62.50, bought on April 28th. Yes, we know where the price is now. But anyway, if we had sold the 62.50 call, of course, for $1.88, we take the risk down to 6.2%. We have a peak profit of 2.6% if the stock's trading right at 62.50. But as you can see now, we're actually in a loss with the income method number 1 because of the movement of the stock and because we wanted to probably go to a higher strike as well. Now, I'm not going to add this one in as a comparison. What we're going to do is add another option here for May. What if I had bought the 65 strike for that 95 cents we just saw on the option chain on April 28th? This would be the income method number 6, a bear call spread on top of the married put. Not done the proper way in this case. So what happens here? The max risk is at 7.5%. We only generated roughly about 93 cents in net premium in this case. Okay. Hold on, everyone. Let me just do this. Sorry, folks. Stephen says he can't hear the presentation. So I'm just sending a quick note. Okay. There we go. Okay. All right, so we'll take care of that. So again, we started with a risk of 8.8%. Generated about 93 cents of premium here. That lowers it down to 7.5%. We leave the upside open, and we're probably looking at around a profit of $300 today. Okay, but for comparison, let's go ahead and add that to the portfolio. And May 21st. So now we'll have our 2 married puts, and this at the money married put with income method number 6 in there as well. So as you can see, because of that bounce, let's clean this up a little bit. Because of the thing that we were looking at here, the obligation of the short call, you do have the chance to enter in another loss with this structure, Dave, which is not what I want to see with an income method number 6. We saw sort of the inconsistencies with income method number 1 by itself at the strike price, but it does give an infinite upside, and thankfully BERY moved significantly to the where that you could have this profit. But again, it's less than just having the married put by itself at the money or having the married put with the strike price at 65 in this case. I know they're tight ranges, but you can see that here. Okay, you took the higher risk with a lower cost, and we're looking about the same profit. It's going deeper in the money with the large move. Adding income method number 6 right away, why is it not as high? Is because we had to give back that $2.50 between the 2 strike prices of that income method number 6, the 62.5 and the 65. Would have had to close that position or allow assignment at 62.5 and buy the stock back at 65. You kept the 88 cents, the 90 cents, 93 cents of net credit from selling the one at 188 and buying the next one at 95. You keep that premium, but you're still at a slightly lower loss here, a slightly lower gain, my apologies, because of that obligation. I didn't mention the income method number 1 was 62.5 because we saw it was already at a loss because of the significant movement. But let's go back and look at another income method number 1, rather than selling right at the money in this case. With a 62.5 after you entered the position, what if we had just sold the higher strike up right away? And if I did the 65 put, I could have sold this 95 call right away as well. I was just expecting the stock to move up, which it did, so we would have looked for a higher premium. Now this one doesn't enter back into the red today. Okay, it's still at a small profit of roughly maybe $58 because of that obligation of income method number 1 with the movement in this particular case. Does give us 2 ways to lose now if there's a large movement. That's why it's never a good idea to not follow the rules in the blueprint. What rules am I talking about? I want you all to remember that when we sell the call against the married put, there are certain rules in the blueprint that we want to see. Remember, this risk was originally $600. When I sell that call initially, I typically want it to represent a third to half of the initial at risk. So I'd want at least a premium of $2, which we were close to with a 62.5 call, but that was too tight of a trade. You had too close of an upper and lower break even for only a max potential return of 2.6%. That's not a favorable structure for me to be in my opinion. That's not the approach that I'm looking for. Okay? Now, this one gives you a little bit better structure. It gives you a little bit wider upper to lower break even, but you would have wanted to roll this call once it started to go in the money in this situation. But again, to compare them, let's go ahead and do that again. Add to portfolio. Now we have our 3 married put structures. The first 2 married puts, the at the money married put with just the income method number 1 at the higher strike, only a 0.7% return, and the at the money put so that we could do an income method right away with income method number 6, and that's only giving us a 5% return in this case. It's not the approach that I take, Dave, and this is part of the reason why. I don't ever want to buy the at the money put because it has the highest time value. At any time on the chain, any expirations I'm comparing, the at the money strike will always have the highest time value. I don't want to pay into the highest time value. I want to pay into a lower time value on that at the money bell curve, in this case. And then as the stock moves up, I want to see an increase potentially in that time premium with the at the money bell curve swelling. Let's see if I can find it here. Sorry, folks. That's not a good image. I'm sorry. Okay, but in any case, so does that necessarily happen? Well, what we're talking about here with the at the money bell curve, we already saw it there once. When you looked at the chain, the highest time value at the time for the puts and even the calls that we were selling was 62.50. So selling the May calls when the stock was at 62, buying the puts in January, the highest time value was at 62.50. So you're taking advantage of the shorter term time value being higher, not the longer term. You're buying into that. But as the stock moves up, this adjusts. Meaning what? So I bought here, let's say at the 65 strike, a little bit exaggerated, I know. The image that I had was too small when I just tried to pull it up in paint there. So it didn't resonate really well if I tried to show it on the screen. I should have pulled up the other slides, but that's okay. So now what happens? I paid into a lower time premium, but now that time or extrinsic value has increased as the stock moved from 62 up to 65 and 66. Now my option is at the money. What happened to the 62.5? It's down here. It's losing extrinsic value faster because it was at the money to begin with. Now it's out of the money. Whereas the time value, although I'm losing intrinsic, I should see a gain in extrinsic value. Does that happen? Well, let's take a look again very quickly. I'm going to try to find a date. I think it was right around the 2nd or 3rd. Oh, I want to go to stock charts. Okay, so it was right around, there's that big gap, but even right before then, we're right around May 1st. May 2nd, when the stock went BERY, started to reach $65. So let's go to the research tool very quickly. Oh no, I wanted to go to the option chain. Okay. I want to go to May 1st. Oh, I'm sorry. It might have been April 30th. I know, just 2 days after. But again, let's go to April 30th. And we're going to, I selected May, I'm sorry. I wanted to select the January position. That's okay, we'll get to that in just a moment. So what we're going to look at here is we know what the time premium was on the position originally on April 28th. So it's 63, 62, not quite there. Let's go on to the next day. I want to get close as 65 as possible. Excuse me, folks. There we go. So, okay, so 65.85. Let's go to January. Originally, we bought the stock at 62. we could have bought the 65 put for 740. Now, that put was 250 in the money. So what does that mean? That means that $2.50 of that 740 was intrinsic value, and the remaining $4.90 was the time premium, the time value, or the true risk. May 4th, stock hits 65 and moves above it. My 65 put that was in the money for January expiration with a time value of $4.90, it's not a lot now because it did lose 85 cents of intrinsic, but the midpoint's $5.35. Time has passed, only 4 or 5 days, but the time value, yes, my put has dropped down. In order for my put to lose from 740 down to 5.35, that $2 or so, to where I originally paid, 740, so that $2.05 we lost, the stock had to go up 385. Okay? So we're still making out positive on the trade at this point. But the time value now, this is all time value, it's all extrinsic value, and it's at 535. The 6250 is at 425. And when we started, it was at 650. Okay, so we lost 225 in time value on this position. There was no extrinsic or intrinsic loss because it's all time value. We've lost it. Here you've actually gained extrinsic value from 490 to 535. It's small, I know, but that's one of the concepts here that we look for with the married put approach. Why we don't buy the at the money right away. Okay, why we don't prefer to buy the at the money, because it has the highest time value, and most options trading is a time value game. So, in essence, Dave, this is sort of the comparison. Yes, we're looking at it on stock that's running. This is why we do it this way, to follow the 3 core principles: the at the money bell curve, the time value decay curve, and forcing an ideal size trade. A lot of times the at the money option will give you a risk of 9, 10, 12% depending on the stock. That's not where we want to be. Even if you can get 2 to 3% for an income method right away, remember the whole reason that I opened, let's see here. Yeah, the whole reason I would have opened a married put to begin with is because in general, and last analysis we did, it was about 66, 67% of the time, we're looking for stocks that are going to move up maybe 3 to 6% in the first 20 to 40 days. This structure, and that structure there, especially with buying the 62.5 put and selling the 62.5 call, does not match my sentiment for this strategy. Even if we included the income method number 6, Dave, to leave the upside open as we saw before, we saw how that turned out. It's only at a profit of about half. Oh, I'm sorry. Let me refresh that there. It's at a profit of about, no, not half, about 2/3, maybe a little bit more of where we are with just the married puts by themselves as the stock moved up in price. Okay? That's my answer, Dave. That's why I kind of compare them this way. Okay, so you say, well, what if the stock had stagnated? It hadn't moved more than 1 or 2%. Well, again, remember, I started off with a risk of 6.6% with my structured married put to the downside. And even with doing the position and starting off with an 8.8, almost 9% risk on the position, and doing the income method number 6, so at least you left the upside open, that only reduced the risk down to 7.5%. So what's more important to you up front? Generating income with taking a much higher risk using the at the money put, which we don't advocate, obviously. You can tell by my discussion, or using the proper structure and then waiting for the opportune time to use an income method and not feeling forced to do it right away. Because even in this scenario where we gave ourselves some upside, selling the at the money call and buying the higher strike to leave the upside open, we're seeing a lower return than just having the married put open after 20 days, 23 days into the trade. And we still took on a higher risk here with the income method, that extra 90 cents, as opposed to just the 6.6% risk we had here with this properly structured married put to begin with. Now, Raymond's question related to this. He says, when to roll the put option to bulletproof the trade? Okay. In general, this wouldn't have bulletproofed the trade, but in general, what I tend to look for, not that chain, I'm sorry, and it's in your blueprint there, but in general, we want the stock to move up 5 or 6%, and we want the stock to be trading above the put strike price. Maybe a little bit more than what we originally saw. What do I mean by that? On this position now that the stock's at 65.85, I could have rolled that income method number 4 position. This is May 4th, right? May the 4th be with you. That's right, it's May 4th. So I could have sold my 65 put for 535, Raymond, and could have bought the 660. I'm sorry, the 67.5 at 660. This isn't going to bulletproof the position at this time. I would typically wait for it to go a little bit more in the money, even with the 2.5 strikes in place. So I think it was in the next 2 days in this situation. 66.26, probably not considering it then, maybe going up to the 70. But when I have this is a personal preference. It's not in the blueprint. It's just a personal preference for me, how I approach it, Raymond. When I have a 2.5 point strike difference and my stock does breach my short put and then goes above the next strike price, in other words, when it starts to get near to 67.50, I'm going to look to roll up to perhaps the 70 put, sort of skipping a step, not try to roll every 2.5 points in this case. We're going to take a look at both. So we've got May the 4th. I could have rolled up to the 67.5. Perfect. There we are. And here on May 6th, I'm pretty sure I'm not going to bulletproof it here, but on May 6th, I could have sold my put for 465 and bought the 70 put for 715. That's good. That's a 250 strike difference for a 5-point gain. Not going to bulletproof it in this case. How do I know that? Well, I could just see the numbers, but let's take a look again. Let's take our original married put. Let's close some of, no, I want that. I don't want that. This one here, not what I want. Okay, so let's go back to square one. The married put I would have used, likely. Mine's a difference. No, mine is this structure. I'm sorry. All right, so we've got the 65 strike, the 440 we were talking about, 6.3, 6.4% at risk for the original position. I'm sorry, it was 740 was the cost. The risk is 440 because we're $2. I'm sorry, we're $3 even in the money. I kept saying 250. We're $3 in the money in that case. My apologies. Now, May 4th, stock's at 65.85, above my put strike price. We could have seen a potential adjustment, selling the 65 and buying the 67.5. And the numbers that we gave, we saw on the chain as end of day, we could have sold it for 535, bought the sorry about that, 535 sale price, and bought the new put for January at 660. Now that would have taken my risk down to 315 or 4.5%. Not quite bulletproof, but I'm moving in the right direction. I've lowered the risk down by about 2%. Waiting a little bit longer. On May the 6th, the stock had moved up to roughly 67.55. We lost some more time value, and we could sell the 65 put initially for 465. We'd buy the 70 in January. That time, 715. So we're paying a debit of $250 to gain $5. Still not going to get us to bulletproof status, but it gets us to 2.6%. And then what if I decided to go out to June? Oh, it's not good enough. Then sell the income method number 1. Playing around with numbers here. Okay, 1.5% risk, 8.8% to the upside in that scenario. Okay. You don't always bulletproof with the first income method number 4 position. It is possible to do if you let the stock run a little bit more. What do I mean by that? Well, I showed you 2 examples here, Raymond, where once the stock went above 65, we could have rolled it, I wanted to wait a little bit longer. When we saw it hit 67.55 up to the next strike from the strike where we were, then we moved to be one more strike in the money from that point and lowered the risk down to 2.6%. Then I could add an income method and drastically have risk reduction. The stock's at 70.39 right now. So I was showing you where I likely would have used income method number 4 for this position if I hadn't done that in the first case. But today, now that the stock's above 70, we've lost more money on that 65 put, and I might go to the 72.50 or the 75, moving up 10 points. Or the 72.50 is, yeah, let's go 10 points. Okay. And this is going to be pretty close to a bulletproof position now. It is bulletproof. The debit to roll was only 485 to gain 10. And that 485 countered the initial risk. We're now bulletproof, and I could maybe sell a 75 call. But again, I might not want to do that at this time. And Raymond, yes, I'm not going to go through all the income methods because this is a public webinar and this will be public. That's more of a discussion for blueprint owners. You could apply income method number 3 with this idea of rolling up the put in this scenario to cancel the risk potentially if you adjusted the time as well. But then you're giving yourself less time based on how you feel the profitability is on the stock position.